You are 26 years old, sitting at a desk in a mid-level brokerage on the 41st floor in Lower Manhattan, running a spreadsheet nobody else in the office understands the way you do. The spreadsheet is a model you built yourself over 18 months of evenings and weekends, tracking bid-ask spreads of 37 small-cap equities against intraday volume patterns and news velocity. And the model tells you every morning with eerie consistency exactly how much slack exists in the market before a price moves against itself. Your title is Junior Quantitative Analyst. Your salary is $62,000 a year. You are not unhappy. You are not particularly happy. You are watching the market the way a mechanic watches an engine, listening for the misfire before it becomes a breakdown. One Tuesday in February you find it. A pharmaceutical company named Helixar Biogenics has a drug trial readout scheduled for Thursday morning. The options chain is massively skewed toward puts. Volume in the week 3 $30 strikes has spiked 300%. The bid-ask on the underlying stock, sitting at $41, is technically tight, but your model is screaming. The spread is an illusion, a paper wall. You write a 3-page memo. You bring it to your supervisor, Gordon Kessler, who runs the equities desk with the distracted confidence of someone who has been right about markets for so long he no longer remembers what being wrong feels like. Gordon reads one page, sets the memo down, tells you it's an interesting observation, and turns back to his terminal. The stock moves on Thursday morning, down 43% in 11 minutes after the trial fails. Every retail trader who owns shares at market open is incinerated. Gordon does not bring up your memo. You do not bring up your memo, but someone else does. A week later, your phone buzzes with a number you don't recognize, and the man on the other end knows your name, your model's methodology, and the section of the equity code you cited on page 2. He tells you his name is Vic. He tells you he runs a proprietary trading desk at Arcadia Capital, a name that appears in footnotes of SEC filings and never in news articles. He offers you $240,000 base, a discretionary bonus tied to spread performance, and a seat at a desk that is not in Manhattan. You take the meeting, you take the offer. You give Gordon 2 weeks' notice, and he shakes your hand a second longer than necessary, and you understand that he knows exactly what just happened. The desk is in Greenwich, in a building that looks like an insurance office and has the security posture of a government facility. Badge readers at every interior door, no windows in the trading room, a Faraday cage blocking all personal mobile signals. 11 people in the room on your first day. Vic introduces you as the new flow analyst and walks you through what the desk actually does. Arcadia is a market maker, not a retail broker, not an exchange participant in the textbook sense, something more architectural. You are the infrastructure. You are the spread itself. A market maker does not trade to be right. A market maker trades to be present. You quote a bid and an ask on every instrument you cover, continuously, in all conditions. You buy when others want to sell. You sell when others want to buy. The edge is not directional. The edge is structural. You earn the spread on every transaction, thousands of times a day, and the aggregate of those fractions of a cent compounds into something that does not resemble a salary. It resembles a river. But the river has to be managed. On the other side of every trade is someone who either knows something or doesn't, and your survival depends on figuring out which one it is before the position moves against you. You are always on the wrong side of information. Every informed trader who walks into your book is a liability. Every uninformed trader is a gift. The job is to tell them apart. Within 6 months, you understand the mechanics cold. You begin to understand what retail order flow actually looks like from inside the book. It arrives in clusters, predictably after news events, after social media spikes, after influencer alerts on financial forums where 22-year-olds in YouTube thumbnails promise 10x returns. The retail trader is almost always late. They react to price rather than causing it. You are on the other side of every one of those trades. You do not feel the moral weight of it at first. You're solving an optimization problem. You're doing your job. The first time it becomes real is a Wednesday afternoon in October, 14 months in. A stock called Murano Systems starts moving. Retail buy flow pours into your book from aggregators, the kind that has no information advantage and exists purely as a function of retail enthusiasm. The stock is up 12% on the day. Then the real flow hits, an institutional block, a sell, large, very large. Your model flags it as informed. You widen your spread immediately, pulling back your offer. But the retail flow keeps coming. Buyers who saw the chart climbing and typed the ticker into their brokerage apps. They're buying from you. You are selling to them. 30 minutes later, the stock is down 18% from the day's high. The institutional seller got out. The retail buyers are holding losses. You made money on the spread. You are supposed to make money on the spread. But you sit at your desk after the close and look at the volume profile, and you can see the shape of what happened. The arc of the uninformed flowing directly into